What is up, fellow
What?
Pidians? What's the haps? It is I, your toast with the most, Satoshi. We're back with another exciting edition of The Pit, and we got some rock solid guest star power here today. One of my favorite traders on Crypto Twatter, one of the people I've thoroughly enjoyed watching their content and reading their threads, and I'm super excited to pick his brain. Robot James is with us, everybody.
Hello, I'm very happy. I'm quite intimidated by that.
Yeah, I'm sorry. I tried not to hype you up too much, but seriously, very much have always appreciated your approach to crypto and markets in general and trading in general. So I think this would be a nice change of pace from like the typical talk that we have on the show. So thank you so much for coming.
Thank you, man. Yeah, I watched some of your shows. They were very cool. You know, you got people sharing trading view screens and talking around the markets and what's going on and stuff like that. And I thought about it, and I'm like, oh man, I can't do anything like that, right? Like I can't.
Well, we could
open up trading view, and I could look at it. I could describe the price, but you know, I don't have interesting things to say about them.
From what I gather, your trading is not you know, the way you approach trading is fundamentally different in a way where it's like, you know, we like to LARP as market commentators or people who have any idea what direction is going to head next. But at the end of the day, like, I really appreciate your approach, which seems to be sort of irrespective of being lucky in that regard, right? It's like,
I'm just looking for technical things, right?
You're looking for scraps to pick up off the floor repeatedly.
Yeah, that's right. So I'm a very disappointing party guest, right? Because people find out that I'm a trader and they have all kinds of questions around the market.
Where's Bitcoin going to be
about
next
this
month?
stock that they've just bought or something like that. And I literally have nothing useful to say about that, right? They go, hey, look, well, where do you think the spoos are going to be in 6 months' time? Or what do you think of this stock that I just bought? Or what do you think of Bitcoin? Or what, you know,
don't know
which chain is the best thing. And I don't really have views. Like I'm just a trader that's just punting deviations from fair value. Right?
So I'm excited to hear about it. It also seems like the more discipline you can apply, the less volatility you will have in your equity curve. So I'm excited to learn a little bit about how you approach things. But
so I made some pictures. Do you guys want to talk for a while, or shall I start a sort of spiel? You guys can jump in and ask any questions.
I want to before you start, I want to ask you one question. I think with every, whether it's market, whether it's sport, it doesn't really matter. There's got to be a perspective around having an edge. When you trade the markets, how would you define you find an edge in the market? What is that kind of like edge that you look for?
And is that a part of your presentation? Because we don't want to stomp on that either.
Indirectly it is, but let me answer it because it's a great question. So I tend to, so when I think of edge, I don't believe I'm smart enough to be able to work out something that other people haven't worked out. So I don't think, and I've never really tried to go, hey, look, for whatever reason the market is underappreciating this specific aspect of something, so this is underpriced, so I'm gonna buy it. I've never really tried, but I don't believe I could do that. I don't believe I have the attention span. I don't believe I have the discipline to do that kind of stuff. So instead, what I'm looking to do is try to look for times when people have to get something done, or they're desperate to get something done, or there's a very obvious imbalance between supply and demand for some reason that I can understand. Then I can kind of go, well, you know, I don't have to know anything that other people don't know here other than to observe that imbalance, right? You know, maybe someone needs to do some systematic trading in size. I can observe that. I can go, hey, look, that's going to make a dent in prices, right? I don't have to be Warren Buffett or whoever, or Soros or whatever, to observe that if someone wants to do a massive amount of trading at a certain amount of time within the next 2 minutes, that's going to make a dent in price, I can get in front of it and I can trade.
Yeah.
So what
you
I'm
sure-
looking for pretty much is those times. Someone needs to hedge, someone needs to rebalance, someone's insanely greedy, and look to take the other side of those kind of things. So I'm looking for repeatable, observable stuff that I can quantify that kind of looks like
You're almost like the bacteria in a whale's teeth. You're just like, when's this whale going to feed? And can I jump in those teeth and catch some of that food as a byproduct?
Yeah, pretty much, which means that, you can only eat what you're fed, right? Like, I can sit around, and if no one is prepared to trade at bad prices, I'm not going to eat, right?
Right.
I need some desperation. I need some price insensitive traders or someone with some weird objectives or something like that in order to push prices away from where I think they should be, kind of make them unfair so I can trade.
So I understand that in the context of like a liquidation cascade, like lick fading is
great example. Yeah.
When I became a profitable trader on a more reliable basis, it was entirely because I was like, well, I know what this is and it's been explained to me properly and I know how to spot it. And so I will only do this until I develop other skills. And that like really turned things around for me. But
have you been reading my slides? Because this is essentially the first thing that I.
Oh, okay, cool.
Yeah. So no, absolutely, yeah. You want to kind of just hone in on stuff that you can really believe in, right? Because trading is hard, and trading's full of uncertainty.
Outside of that specific scenario, what tools or prerequisite knowledge do you need to bring to the table in order to be able to be confident that you're spotting something? Like, because you said, I want to trade where people are forced to trade. How do you know when someone is forced to, for instance, like do systematic trading with size or to hedge with size or whatever?
Well, sometimes you can just kind of find that out, right? Because if you're immersing yourself in the market and you're learning about various things that happen through your own research and through conversations with other people who do it. So, for example, like in TradFi markets, it's sort of well known that certain funds with large amounts of assets under management do systematic rebalances at certain times, right? It's well known that employee share programs kick in at certain times and things like that. So by immersing yourself in the market and talking to people, you can find out about these things. You also can find out about them just by watching, right? You watch, you ask questions, you ask other people questions, and you can find out. Mostly it's just immersion in the market, right? Just be in the market, be involved, ask good questions.
Okay, I think that's a great jumping off point to get into your slides. Before that, I just want to introduce everyone because I forgot to mention with us, of course, is one of our favorite guests to have on, pretty much a regular at this point. So welcome, Jedi, and thank you for being here, even though you are now blacked out and we can't see you.
Did we lost Jedi?
No, I'm still here. It's just that my internet connection on the southern tip of Africa is not great. And thank you for the introduction, sir.
You are very quiet. You are very quiet.
Yeah,
but it's okay because Toast repeats your question loud.
Or turn it up. And let's get into this presentation because I'm sure there will be a litany of follow-up questions to go.
Yeah, so I used to be a consultant in the banking industry, which is why I've come like a good schoolboy, like with presentation.
Dude,
I also like drawing pictures. I also like not forgetting interesting things that I wanted to talk about.
Yeah.
So Toast, this was kind of cathartic for me because I stopped trading crypto end of 22 because I was tired mostly.
Yeah.
And I use this as an excuse to sort of, I don't know, do some sort of banishing magic ritual or something, and just kind of put out into the world all the things that I wanted to talk about, which is mostly just most of the trades that I was doing in crypto. I want to go through, and I wanted to talk through why I was doing them. I'm going to talk about this as if it was me in order to kind of protect the innocent. But there was a team of us, right? There was a team of sort of between various points.
So it was you, Jim
four
Talbot,
or 5 of them led by me.
Yeah. You and a collection of CT characters like the Rogues Gallery going after the.
Yeah. So my plan today, like, I just wanted to talk. I came from TradFi, mostly trading ETFs and futures instruments, and then I decided that we would start trading crypto, despite the fact that I knew absolutely nothing about about crypto or cryptography or computers or any of the projects. Or
Doesn't seem like that's required.
Well, exactly, yeah. So I'm going to talk about, how to approach a market that you basically know nothing about. I'm going to talk about some sort of psychological stuff, especially for any sort of wannabe quants involved. Like a lot of people that listen to me are very sort of quantitative in nature, and one trouble that they tend to have is that they're sort of creating projects for themselves rather than just getting their head down and making money today. So I just wanted to kind of brainwash everything with that. Then I just wanted to talk through 9 trades that I did. The first one will take a bit of time because I want to explain what a future is. The rest of them will smash through. And my hope here, Toast, is that we sort of kind of brainwash people into the at least the way I'm thinking about edges and what I do and how these.
I love it. If we can get people to take a little bit less, sort of blind, emotional, directional punting and get them to something a bit more systematic, that's a win in my book.
Yeah, I hope so. Well, at least I think, betting on your own skill isn't always the best idea, right? Like betting on the fact that somehow you're going to absorb enough nuanced information to make money with your own sort of skill and intellect is a pretty crazy bet, right? Like it's
tall order.
It's a big bet.
Yeah.
So anyway, so I would sort of let's storytell. Now this is me. Well, this is me in my internet persona, knowing nothing about crypto but being a decent trader gambler. Okay. And I'm looking over here at the crypto market, and it's got all of the characteristics that I like in a market if I'm trying to create edge, right? It's new, it's inefficient, it's got rampant flows going on, it's highly volatile, it's highly leveraged, it's highly fragmented. The whole thing, the same thing trades all over the place in different places.
So just to clear though, like, because it's fragmented, that multiplies inefficiencies, right?
Yeah, absolutely, right? Because price discovery, doesn't happen all.
It doesn't happen at the asset level. It actually happens at the pool level.
Yeah, right. Yeah.
Yeah.
Absolutely. Yeah. So if you then split that up and spread it out, you create all these lead lags and all these inefficiencies and all these sort of frictions between it, which can create inefficiencies that we can trade. So this is me, right? Like I'm sort of scrambling around for basis points. I've been trading a lot of inverse leveraged ETFs. I've been doing some future spreading. I'm sort of had a less than successful attempt to do some relative value option trading. It just got very, very hard and very, very difficult. So I'm looking over here going, wow, look, there's all this sort of inefficiency over here that if we can just work out how to trade the crypto markets, we'll be able to go and harness. And my mindset at the time is that I don't really know anything about anything, but I'm not really that worried about that. Because if I'm sort of bluntly honest, I didn't know much about the stuff I was trading in the first place, right? Like didn't know much about that.
This tweet exemplifies that to a T, right?
Yeah. So I knew how to trade, I knew how to gamble. We go, hey, look, let's see if there's a lot of technical effects that I can see in crypto. Let's see if we can then go and use those. Okay, just go and use our gambling skills in this market, which looks pretty inefficient. And the reason we think that is we can see an awful lot of really obvious dislocations in the market. Okay, and I understood why this was the case for some of it. I didn't understand why it was the case for others of it. But we've got things like this, where the same thing. You've got same thing trading in one place higher than it trades in the other. And maybe there's good sort of structural structural reasons why that's the case, but probably not all the time, right? Sometimes there's the chimpanzee trade of selling the more expensive one, buying the cheaper one,
and then waiting for them to come back into equilibrium, or trying to transport it over to the venue where you can sell it for higher.
Yeah, that's a good question. So there's you've described sort of two types of trades there. Like, one is the sort of classic arbitrage, right? Where you go, hey, look, this thing here, you can see my mouse, right?
Yeah.
This thing here is cheaper than this thing here. So I'm going to buy this thing over here, then I'm going to shoot it over to here, then I'm going to sell it here for more expensive. And that, that requires that instrument is fungible, which means that I can buy it here, shoot it to another exchange, sell it over here. Now, the second one that you described, I would call like a statistical arbitrage, right? Which is
where you expect the arbitrage to close at some point.
Yeah, it's a fancy word for a bet, right? Where you go, hey, look, I'm not going to do the transfer between the venues or whatever. I'm just going, this is too expensive, this is too cheap. I'm going to buy this one and I'm going to sell this one at the same time, right? So I'm getting into a trade where, so in the first case, I was getting into a trade where I could see how I was going to exit it, right? I was going to buy it too cheap, shoot it over here. I knew I could immediately exit if I could do it fast enough. In the statistical arbitrage, I'm putting on the trade at the same time with no idea how I'm going to get out, right? All I think is that over time,
this spread should narrow.
It's going to narrow, but it doesn't have to, right? It could come apart, right? Which is why we'd call that sort of statistical arbitrage, and the other one an arbitrage.
And there's ways to get some of those characteristics over from stat arb to just arb, where like, okay, I'm going to buy it here, ship it over and sell it there. But I don't, if price moves in that time, I'm exposed to that price volatility.
Absolutely. Yeah. So there's never really a real easy arb there, right? Because you've still got the time risk. You've got, all of the frictions associated with it.
Okay.
But I'm just looking at this going, if this was TradFi, this stuff would be trading an awful lot closer, right? It would all be trading real tight, and it's trading real sloppy. So let's be interested and get involved. And particularly, I was looking at futures, right? Futures that were trading a long way over their terminal value. So futures expire. We'll go through this. Futures expire to their index on expiry. We were looking at futures contracts trading at massive premium, 20% or something, to where they were going to end up, which is, a sign of sort of rampant demand, and a sign of not enough boring people like me doing boring arbitrage type trades. You've got a lot of people looking to YOLO into the market, but not too many people willing to take on sort of, I guess, more mundane, more grindy sort of arbitrage type trades.
Well, so I'm looking at. You're talking about actual futures there, not perpetual futures, right?
I'm talking about actual futures, yeah. So I didn't know what, at this point, I don't know what perpetual futures are, right?
So I'm just looking at, right?
Yeah. Great. Okay, cool. And a fantastic product. Way better than like the CFD type stuff that existed in TradFi before. So then we go, well, how do we start? And this is a good question that I think lots of people sort of struggle with in trading, especially nerds, right? Nerds struggle with this. Degenerate gamblers tend to struggle with it a bit less. Where, you're looking at what you think you're going to need in order to take advantage of all these inefficiencies, right? And if you're in my kind of nerd world, you're looking at this going, hey, look, I'm going to need some analytics. I'm going to need some databases. I'm going to need some tech. I'm going to need some trade automation. But you don't have any of that, right? You're looking at that and go, like, I want that stuff, right? I would like that stuff in the future, but I don't have any of it. I'm over here with absolutely nothing. So what most people want to do is they want to kind of get their head down, get into the back cave, start making this stuff, just sort of knuckle down, just start making this stuff, smash out a load of technology or whatever. And that's a really bad plan, right? Because if you're not interacting with the market, you have no idea what you want over here, and you're going to be solving pretend problems. You're not going to be solving real problems. So whilst you're over there sort of with your head down in your cave, creating technology, creating code, creating things like that, you're not learning what you're going to need because you're not really interacting with the market, and you're not making any money, and those things are bad, obviously. So you need to learn as a trader to be myopic. You need to basically ask this question every day, which is, given that I'm over here and not over there, right? Given that I only have the skills, the technology, the energy that I have today, how can I give myself the best chance of making money today, right? And that's you're a trader, not a project manager, right? Your first mission is, I don't care if you've just only got Google Sheets and and a mouse, right? Like, what is the best thing you can do with Google Sheets and a mouse today? Right?
That really speaks to me, because I do not know Python, and I don't know how to either research or execute in a like a quant does. So the fact that you said that really warms the cockles of my heart, sir.
Yeah, well, you don't need that stuff, right? Really, you need to find edge in the market. Then when you found it, you need to just smash it, right? Like, that's the end of the day. So if you have some edge in the market, like number one thing is just smash it, right? And then you eventually, when you get tired, right? You get tired or you get overwhelmed, and you're iterating over here, right, to the fact that you can do more scalable things. So this is a kind of this is the kind of complaint of people who are sort of, I guess, more on the nerd end of things. When I say stuff like that, they'll go, well, I can't make money today, right? Because I don't have the technology and the tools and the processes and the data and the, all that kind of stuff, which is really kind of a failure of balls and a failure of creativity, I think, right? No, you've just gotta force yourself, right? You're a trader, you're not a coder, you're not a project manager, you're not something like that. So you've got to get creative. You've got to ask yourself these kind of questions. What can I do right now, very likely to make money with what I have today, that I can execute manually, that's not going to take up all my time, that will start pushing me from where I am to where I want to go. And that's number one priority for everyone. It's kind of, trading's messy, right? It's punk rock. It's not classical, right? Like, you've just got to get stuck in and start doing it, right? If you're getting prissy about it, you're never going to get there, right? Because the future never arrives, right? You're going to be building stuff for some kind of future that never turns up.
I come from the entrepreneurial world, and there's just so much direct analog here, which is like, all the time I get people who want to, like, I have a business, and I get people who want to start a business talking to me, and they're like, so should I get my logo and like get registered and like, have a business plan and all that? And I'm like, well, you've never sold a product to anybody, so none of that shit has any point to it whatsoever. Make a product, sell it, and then you can start worrying about professionalizing your business.
Yeah, that's right. I mean, you've got no idea what your problems are until you start doing.
Yes, dude.
Right? Like, you're gonna be solving imaginary problems rather than
big
real
time.
ones. And your imaginary problems are a lot more exciting than your real problems, right? Your real problems are mundane and annoying and frustrating.
And they make you feel a lot smarter you're planned out all this stuff.
Yeah. Living in an imaginary world is way more fun, Toast. So then going back into me, right? I'm looking at crypto. I don't know anything, right? So I'm going, hey, look, what's the most and I have absolutely no intuition on the market. I don't know anything. I don't know how anything works. I don't know how the exchanges work. I don't know anything. So I'm going, hey, look, what's the most obvious, most forgiving, most accessible opportunity I can find, and let's start doing that and start learning stuff. So I studied here, right, I started, well, the most obvious thing that I noticed when I was looking around, and I'm lying a bit, right? I'm talking to other people that are doing things as well, but I've got a story to tell here. I'm looking at futures contracts that are trading 20% over where they should be, or where I think they should be. So I'm going, well, that's interesting, right? Like, let's go and start there. And this is where I started, like not doing trades on futures contracts like this, actually, but doing trades on perpetual futures. And I'll get there. So, Toast, I'm going to talk about a short basis trade in perpetual futures, but first I have a bit of science. So I didn't want to assume that everyone knows what a futures contract in a perpetual future looks like. So probably for the next 5 minutes, I'm just going to explain what a perp looks like, if that's all right, and then we'll get back onto the interesting bit of how I traded it.
Let's go.
So here's a screenshot I had hanging around. Right, this is the Bitcoin December 21 futures contract on FTX, and the candles that you can see here are the value of the futures contract. The blue bit here is the index that futures contract eventually expires to. So it's
interesting how they converge on big nukes. It's like, oh, you realized all of a sudden this isn't
Yeah, I know, it's fascinating, right? So imagine this thing expires over here, right? What we know, this index here is a collection of spot prices on various exchanges. What we know, because the contract is written this way, right? Okay, it's designed this way, is that on expiry, the futures contract is going to settle or converge to the value of this blue line, right? But you can see here that it's not trading at that blue line, right? Like at the moment, and at certain times, it's traded at a massive premium to that blue line. So we don't know what's going to happen. We've got all this time until this thing expires. We don't know what's going to happen, but we do know that these green and blue lines are eventually going to come together at expiry. Okay?
Yeah.
And why is that? Well, we never really know why things happen, right? But we can sort of be roughly in the right direction of that answer, which is that basically just loads of people wanted to get long this shit, right? There was sort of massive demand to get long this stuff, and less people doing kind of boring stuff.
Well, also, like, correct me if I'm wrong, but like there's the dislocation is that people want long exposure either with leverage or without underlying exposure, right?
Yes. Yeah.
Okay, cool.
Yeah, that's right. So you've got, if you think of anything like this, right? This futures contract's trading above where it should be, right? Why has that happened? Well, it's happened because there's excess demand versus the supply of it. Right? And we go, well, it's easy to understand where the demand comes from. Like you say, lots of people want leveraged exposure to this stuff, or certainly did back in, I think beginning of 2020 that I was looking at this stuff, I think, or end of 2019. And then you look at the supply. Where's the other side? Well, that's mostly people that are being prepared to get short that instrument for that small amount of edge, right? If this thing is trading at a 10% premium, it's got 3 months left on it. Plenty of people like me are prepared to get short stuff like that, especially on leverage for a 3% a month return. But in a rampant bull market, lots of people are going to look at that going, no way, like my mate got 200% last month, right?
But this is like, that's 200% he might get. This is 10% you will definitely guaranteed get if you wait those 3 months.
Yes.
Depending on how you put on the trade.
Yeah, as long as you don't blow up. Yeah. So the trade expression here is obvious, right? You've got one thing that's too expensive, one thing that's relatively cheap. You can trade the spot. If we're talking FTX to keep it easy, because that's where the example from, we could have traded the spot at FTX and sold the future in the same quantity. That then means that we are going to realize this expected return, the difference between this, as long as we can hold on to it till expire.
As long as Bitcoin doesn't 2x and you're on 1x leverage, like, you're good.
Yeah, it's right. So as long as we maintain sufficient margin to not get liquidated out of this position, these two lines are going to squeeze together and we'll reach convergence at expiry. Now, as Toast, who's been front running my slides all day, will say, yeah, that's not as easy as you might think necessarily, because two things can happen which can wreck you, right? One is that there's no real reason why the basis, and by basis I just mean the difference between the premium that the future's trading over the spot, right? There's no real reason the basis can't blow out even more, right? And that's going to hurt you, of course. So, what might happen, and this kind of stuff certainly did happen, especially in the shitcoin futures, right? Just people would blow them up for various squeezy reasons, right? And these things would blow out, and that can hurt you. The other thing which Toast said is, that if this thing is going up and you're doing it on leverage, well, not even, right? You still got to margin your futures position. Then your position's getting bigger and bigger, okay? And you're requiring more margin as a percentage of your position. So if this stuff is going up and up, you need to cut, right? You need to cut size. You need to reduce the size of the trade, which can hurt a bit. But these things don't mean it's a bad trade, right? Trades which are high risk reward and easy don't exist, or they don't exist for long, right? If a trade was high risk reward, operationally straightforward, low risk, everyone smashes into it, right? Because why not, right? It's high risk reward, it's low risk, we all smash into it, and then it stops being at least one of those things, right? It probably stops being profitable, right? Because we all ape into it and we all smash that future down, right? If we all jumped in there, we smash that future down, now it trades nice and tight.
I mean, it's not a popular trade just by virtue of the fact that it exists in the first place. The inefficiency.
Yeah. Oh yeah, smart. Yeah. So because it exists that it's not a popular trade, basically. Yeah. Good point. Yeah. So when we're looking at this stuff, when we look at a trade, we always want to know what sucks about it. Right? Like if we were looking at that and go, hey, look, what was that thing that Raoul said? It's practically risk-free, right? If we're looking at that thing, we go, it's practically risk-free, it's easy, it's obvious. Well, we want to be really scared then, like if it's really risk-free, if it's really obvious, what have I missed? Like, why aren't other people aping into this and smashing it down? So, so at this point, I'm happy, right? I've found a trade that I think is obvious. I also understand why it sucks, which is really important, because I don't want to be competing with people, right? I just want to be doing useful things for the market. In this case, I'd look at this trade and go, look, the market needs more supply from boring ass people like me who are prepared to take the other side of something that's a bit too expensive. Right? So I'm looking at this stuff going, like, I'm relatively happy, right? And I didn't actually do this trade. I did a similar trade in perpetual futures, which I'll talk you through. The reason I showed you this one is because it's conceptually easier. Slightly.
Yeah, you're not going to understand the perpetual one until you get this as a baseline.
Yeah, exactly. So here's me talking about perpetual futures, right? The reason that the sort of dated or the expiring future here stays roughly tethered to the spot price is because of the expiry, right? By design, we say, hey, look, it expires to the value of the index, and that kind of keeps these prices tethered to each other in a way, right? Obviously there's still this premium or basis that's here, but we know by expiry these things are going to be the same value. We can think of a perpetual future as it's a future that never expires, but you can really think of it kind of as one that expires every hour.
Right. There are market forces pressuring it towards the index.
Yeah, absolutely. Yeah. So we invent this thing called it's a really good product. Really cool product. There's this thing called the funding cash flow, right? Which is every hour, every day, depends by exchange, right? There's a payment that happens between longs and shorts. And the point of that payment is to make it more attractive to be long when it's under the index and when it's trading under the index, right? Because you want to add excess supply to push it up. Or less attractive to be long when it's over the index, because you want to make it more attractive to push it down. So when the future trades above the index, longs have to pay shorts, so effectively adding this extra supply to kind of donk it down. When the future trades under the index, the opposite's the case, right? Shorts have to pay longs, right? And the amount, at least the thing we're talking about here, is effectively the average premium that the future's trading over the spot each day. So this is a nice kind of thing that is sort of like an expiry event on a regular basis. And the impact of this is that the perp trades a lot nicer, as you all know, right? Because it's effectively expiring hourly or 8 hourly or whatever it is.
Yeah, it's almost like the regular futures, like the market is going to pay someone to keep it more in line with the index at this date. And they, like with perpetuals, they were like, why don't we just pay it to them directly? And then it'll always stay more in line.
Yeah, that's right. So it will stay a lot closer. So naive, and you can see this, right? That's what it's supposed to do, and it does it, right? This is why it's a good product, because no one wants to YOLO a future which is 20% higher than spot, really, right? They want to trade something that trades close to the underlying. And you look at this and go, well, hey, look, now there's only a tiny little premium on this perpetual. Maybe there's not a trade here, but there was, and there actually was one that was better than the dated.
Less risk, is that why it's better?
Better and higher expected return, and I think that was simply because more people YOLO'd the perps, right? People just preferred the perps, right?
Yeah, your average crypto participant isn't very well, like they know how to YOLO perps. They don't know what they're doing with like expiring futures.
Yeah, which is sort of understandable, because you'd look at it and go, hey, look, this is a wild, perhaps, at certain times, right? We're back 2019, 2020. You go, hey, look, this future's trading a wildly different number to the thing that I wanted to trade. So I don't understand that. I'm going to go and do something else. But the reason,
it's almost like they're not even paying attention to that part.
Yeah, or maybe, yeah. Yeah, who knows? So the perp effectively pays funding. So if the perp is trading at a premium to the spot, longs will pay shorts funding, right? Because you want to make it more attractive to be short, to push it back down towards the index. You want to make it less attractive to be long. Okay. What we found. So I did some. I'm just pulling data into spreadsheets and stuff, doing some basic analysis, and we found that there was a lot of stickiness associated with that funding payment or that premium. So although we've basically only got,
when you say stickiness, you mean like do you mean it tends to stay dislocated for longer than you would expect? What do you mean by that?
So what I mean by so remember this basis trade, right? We absolutely knew this thing was going to converge, right? We put on the short here, we put on long here. We know for a fact this thing is going to converge. For the perp, we've essentially put an artificial hourly convergence in here, kind of, right, with that cash flow. So, but an hour's worth of funding isn't enough that we can get long and get short in order to harness it, right? Our trading costs are way bigger than an hour's worth of funding. So in order for us to have a similar trade, we would need to get long this thing and then hope that it stays paying us funding. Get short this thing and then hope that it stays paying us funding for a few days, right? Which means that if it's
Yeah.
trading at a premium now and paying shorts funding, we need that to stay the case for at least 3 days, 5 days, something like that. And that's what
Yeah.
I mean by stickiness, right? We found that if the perp's been trading at a premium and paying shorts funding, it's more likely to keep doing that. If it's been trading at a discount and paying longs funding, it's more likely to keep doing that. So we can find that we can predict what funding is going to be in the future by just what it was in the past, which is very nice, right?
Yeah.
And there's some science which is it's basically showing the correlation of the perp funding rate with itself, and you can see it just sort of a good prediction of the funding rate is just what it used to be, and eventually that decays, but not quickly, right? It's very, very
And the more dislocated the funding, the less likely it is to persist, right?
yeah. So there's some subtlety around that, but
That's kind of implied edge all by itself. Like,
Yeah.
if you see massively dislocated, that like this can't live long.
Yeah, and you can sort of see that. Yeah. At this point, I don't know subtleties like that, right? So you've picked that stuff up, right? Like at this point, I don't really know anything except for the data analysis that I'm doing. So I'm looking at this stuff, going, "Hey, look, this thing's sticky, right?" And that's basically all I need right now in order to make a trade around this. So I'm saying at this point, I'm looking at trading costs, and I'm going, look, what I want to do is I just want to ape into everything, I just want to do these trades, right? Short futures, long spot for everything that's had the highest funding rate over the last few days. Okay. Because I know it's sticky and I just want to sort of ape into that. And if it stops having a super high funding rate, I'll come out of it, go into something else that does. Yeah. But my problem with that is that it costs me every time I trade. Right. So I can't just, whilst if I'm doing a simulation or something, I can hyperactively jump around from opportunity to opportunity. In real life, I can't do that because I've got to pay quite a lot to get in and out of a two-legged spread, especially on a shit coin. So what I'm then doing is I'm going, well, finger in the air, right? Let's just say that to reduce my costs, I want to only be in things that I think are gonna pay me for at least 5 days. So that's what I've done here, right? I've gone, what I want to do is predict funding over the next 5 days. How can I do that? And I found that, if I just assume that funding stayed the same as what it was over the last 3 days. So I'm assuming, hey, look, what was it on average over the last 3 days? On average, that's a decent prediction over the next 5 days. So I'm just going to use that as my trading strategy, my prediction. Right? Like I'm just going to look to see what had the biggest funding over the last 3 days. Then I'm going to put this trade on, short the futures, short the perpetual future, long the spot. And I'm going to try and manage it. So I did 2 things at this point. One, don't mess about, right? Just the moment you have a good idea an idea that's good enough, get in the market and start collecting real intelligence about trading it. Right, don't nerd around in simulation mode. Right, get in the market and learn how to put the trade on, how the margin works. How to click the right buttons, how to press buy instead of sell. All that kind of stuff. Right. So your first mission. So first thing we did is just put it on in the most liquid thing. Right, and I think we put it on in Bitcoin probably. Right, that makes sense, right? So even though Bitcoin probably wasn't trading at a massive premium at this point, we would long Bitcoin, short the perp. Then you've got to do the boring work, right? You've got to go through, you've got to make sure that you understand exactly how your P&L changed. It came from changes in the price of the future, changes in the price of the spot, accrual of funding into your cash balance, and just go through and reconcile all that tedious stuff, reconcile your margin use, make sure you understand it. That's your boring eat your vegetable stuff, and you've got to do that, right? Then we went and simulated a simple systematic trading strategy. Now I did this because I can. I don't think you need to do this. Like, I think based on the evidence that we've just seen, you could quite easily justify just aping into these trades without doing any kind of back test or simulation or anything like that.
Correct me if I'm wrong, but like one thing that's out of my reach that you did was your spreadsheet work to determine the stickiness of the funding and then that scatter plot. Like, I don't know how to do all that stuff, but I could probably gain similar conviction through just like manual analysis, correct?
Yeah, I mean, you could have just plotted the funding rate, right? And you could see that it tended to stay higher or it tended to stay lower.
Yeah.
So I do this stuff because it's the best way to analyze it sort of sensibly. And
you don't have to. I should
and because I
excuse my
can,
lack of
right?
information. You don't have to excuse that you did it.
No, but I guess what I'm saying is there's nothing special about that, right? There's nothing special about the way I analyzed it. You can come to that same truth, or that same insight by whatever way, right?
Right.
Including just by watching stuff and getting a feel for things. That's a perfectly reasonable way. So yeah, I did this simulation where I'm just going, hey, look, for all perps with over $1 million traded a day over the last, on average over the last 5 days, what if I was into what if I just got into this trade on the 10 best opportunities, right? So I just filter by funding rate over the last 3 days, and then just put this on up to 10 trades where the opportunity is going to at least be over 20% per annum. Okay. And this purple line is the P&L from that, right? And you can see that it is beautifully up and to the right. Right. Very, very effective trade. Makes a reasonable amount of money. So that's over sort of half a year. I think it's made about 50% over sort of 5-6 months or something over this period. And you can see that, nearly all of the returns, this is the returns from funding, right? All of the returns pretty much come from funding, right? Your funding returns are higher than your strategy returns. Why is that? It's because you pay costs, right? You pay costs getting in and out of this trade. So it's a very, very simple chimpanzee trade where you just get long the stuff that's paying, get short stuff that's paying shorts funding. Then you try and minimize your costs. And that's a trade, right? No, this funding's coming in. It's coming in. Your job is to try and minimize the costs associated with it.
Now, correct me if I'm wrong, but you could prevent yourself from being exposed to that basis blowout where, yes, I'm long this on index and I'm 1x short on futures, but it's going to go, if this thing 2x's, I just got liquidated on that 1x short. But if you're margining it with the index asset, then doesn't that completely prevent that? Or do you find because of that, there's less opportunity in coin margin contracts?
There's less opportunity. If you can totally margin it, there's less opportunity. Yeah.
Right.
A lot of the things that was trading at a huge premium was stuff that that required enormous amounts of margin, where you couldn't really offset with the spot, which makes sense, right? But yeah, if you can just effectively long the spot, short the same thing, and have almost 100% margin from the spot to the future, then your risk of getting blown out of these things was pretty small. Right. When I started, I was doing this on FTX, where for some cases you could use the spot as about like 95% margin of collateral. For some stuff, you just couldn't really use the spot, right? Like if you're looking at this stuff like Dawn or something like that, then you probably can't use Dawn spot as collateral against your futures position.
Can you use Dusk as the collateral?
Yeah, maybe. Given that it was all backed by infinite amounts of crime, maybe they could have changed that. So we had this spreadsheet, right? Like that just forecasted what the funding was going to be, and we just try and be in the top names and filter out. And what we found doing this, right? you always learn lessons, right? You never know what you're doing when you start. Right? You go in and you start learning lessons. Execution, by far the biggest challenge, especially in shitcoins, right? Because we expected to hold positions for about 5-7 days on average, but especially with like dawn and dusk, all that kind of shit, right? The costs to trade in and out of a spot futures pair, like a spot future spread in a shitcoin, are big compared to the expected value of 7 days of interest, right? So execution is really important in trades like this, because one fuck up can just ruin 5 days worth of funding for you in a
Can you go a little bit into that? Like what are the execution requirements? What is a fuck up? Like why does it cost so much?
Okay, so what we're trying to do here is put on delta neutral positions, right? So we're let's take dawn. I don't remember what dawn was, but it sounds crappy, right? Let's take dawn, right? We don't want to have a directional exposure to dawn, right? Like we got no. That sounds like a very squeezy thing. It sounds like a thing we don't probably really understand. I'm sure it's total trash. So I probably didn't know what it was when I was trading it. Probably had no idea. So I don't want to take a directional exposure to dawn, but I also want to get in a reasonably sized position, long dawn, short dawn perp, such that I can collect a reasonable amount of funding on it. And if I looked at the book, especially the spot book, I'd probably find that there's not much liquidity there. Right? So if I were to just go in and just smash through an order of 20 grand of dawn spot, 20 grand of dawn perp, 2 market orders, I'm going to make an almighty mess of that trade. Right? I'm just going to smash through the book on both sides. I'm going to get horrible prices. And the amount of slippage that I incur doing that uncarefully is going to be way more than...
You could cause the basis to go negative, right?
Right, yeah. So I can ruin my own trade. I'm also just going to be trading at bad prices compared to where I should be, which is going to be way bigger effect than 7 days of funding. So instead, I need to split up my orders, right? I need to be intelligent. I probably need to quote one side, maybe jump, quote the illiquid one, quote the spot. When I get filled on the spot, maybe I'll take liquidity on the future. I need to be smart about it, because I'm trying to manage my directional risk. I don't want to be in lopsided positions where I'm long spot but I haven't got the short on yet, but I also don't want to make a mess. I want to get good pricing. So there's a a bit of skill to that. Not much, right? Most of the problem is just splitting up the orders, right? If I want to get into
right, because
10
like
grand,
that time
then...
risk thing we talked about is almost like there's a mini version of it in just executing and getting into the position.
Yeah, I mean, like with all this stuff, the trade's easy, right? The trade is straightforward. The skill is in executing it at size without making a mess, right? And what that ends up looking like is that almost all of the time in these trades, we were just opportunity slow. We've got the positions that we have on, right? Then in our minds, we've got the positions that we want, okay? But we can't trade directly into the positions that we want. We need to be trading really slowly away from the positions that we have on that we don't want, and really slowly into the positions that we want that we don't have on. So the whole portfolio is just very slowly molding, right? And we were doing that opportunistically. If someone jumps over and there's a nice quote, we'll come and pick it off if it's something that we want to move into. So nearly all the work around this, the trade's absolutely dead simple. Right? Just ape into anything that's paying the most funding. But nearly all the work is around, well, how do I do that and minimize my costs whilst giving myself the best chance to make money? So that was all, to start with, that was all caffeine and finger clicks, right? And then slowly you've got replaced out just sort of semi-automated stuff with execution algorithms. But basically, your execution algorithms, we were starting by sort of quoting the spot leg. When we got filled on a bit of spot, we would take on the perp leg. Then we sort of moved basically then to taking more directional risk when we got more comfortable, where we were sort of effectively trying to quote our way in on both sides.
Yeah, for the apes in the audience, when he says they quoted on the spot, what he means is he placed a limit order. And I know you guys aren't familiar with that, but limit order means he's providing liquidity in the book. And then on the futures pair, he would just smash it market for the same relative size as he got on the limit order.
That's right. Yeah. So the point of this is is not for me to talk about my execution woes, right? Nearly all my effort was around this, right? How do we actually execute this? And that's common in trading, right? Your actual trading idea is usually incredibly simple, right? All we're doing here is going, hey, look, funding's sticky. I can predict funding by just what it used to be. So I'm going to put this trade on in the stuff with the highest funding over the last 3 days. That's straightforward. That's embarrassingly simple almost, right? But your whole problems are operational. Your whole problems are, well, how do I actually do that without paying too many costs? How many people do I need awake throughout the day? All that kind of stuff.
Yeah.
And that's going to be a theme of the other stuff that I talk about, right? That is that the trade's simple, but actually maybe doing it isn't quite as simple as you thought. So this was a great trade for a while, but of course this imbalance of demand and supply isn't going to stay like that forever, right? And by late 2021, here's our P&L, right? Up here, by late 2021, you can see that, the environment has changed a lot, right? So this is assuming starting capital of 1,000. By the time we get up to 2021, you can see you've kind of just sort of flatlined, and you can't.
Did you guys take any opposite basis? Did you guys take any long the future and short and sell the underlying?
Yeah, we did. Yeah, we did sort of around sort of 2021, late
mid 2021 was a good opportunity.
Yeah, because you also found that the borrow rate on the spot was pretty sticky, right? So you could less so, it was noise, but you could also sort of construct these trades. And at the very end, I'll show you a trade we did where we just got rid of the spot leg altogether, right? And we just did this dirty carry trade where we're long the stuff that carried the most and short the stuff that carried the most. But I'll get there. So here's my lesson: that in immature markets, just imbalances of supply and demand can generate very obvious trades, right? They're usually operationally awkward, and that's a good thing because if they weren't, they wouldn't exist. So your problem. So I think people look at quantitative trading and they think that it's all very smart. The core idea tends not to be, right? The core idea tends to be something that's almost embarrassingly simple. But the actual execution of the trade, actually doing that trade's a bit annoying, right? You could easily have done this trade as well yourself, but you'd need to be being careful about taking it off, putting it back on, making sure you're not paying too many costs, right? Don't overthink these things because they don't last forever. So, I absolutely could have made a better prediction of funding rate, right? Like Toast immediately said when I talked about it, right? Well, actually, you see sort of a pretty extreme reversion at the end of this stuff, which I didn't model, right, until later, right? But, you're probably wrong to model that to start with. When you find a really obvious effect, just model it simply as possible. Get your money funnel in there and try and pull as much money out of it as you possibly can, because this stuff isn't going to last forever.
That's great.
Right. So that was my short basis trade. So we've got a question, haven't we? Shall we pick up this question before I start talking about some other things that we were doing?
Someone had asked, is a stat arb the same as pairs trading? Which
yeah, basically. So stat arb is just geez. I think it's just a word that Wall Street types created to describe good bets. Typically it just means long short trading that's expected to make money.
But rather, like, isn't a stat arb typically applied to a case where both sides of the trade reference the same instrument?
Yeah, it can be. Often it's just sort of a name for a relative value trade, where, like, I don't know, you found 500 stocks and compared them in some way, and you're short 250 of them and long 250 of them.
Right. Okay. Yeah.
It's. I think the one thing it does have as a feature, at least how it's sort of, I guess, popularly used, is that you typically not having any directional exposure to the market, right? So you
Right.
typically be as long as you are short by some criteria.
Yeah.
But it doesn't. Don't get hung up on it. It's just a fancy marketing word as much as anything else, I think.
Yeah, but I'd say it's easier to define why pairs trading is not stat arbing than it is to whatever, because like pairs trading, you are taking on directional punt exposure in a way. A lot of times people are pairs trading something they think is weak, they're going to short it. Something they think is particularly strong, they're going to long it, and they're sort of hedging out their risk of the whole market tanking or the whole market, mooning. Like, because if it moons, like their short won't do well, but they should get a basis. So best case scenario, they get the difference between the two, and some extra exposure. Worst case scenario, they just get the basis.
Yeah. So I'd say probably pairs trading is a subset of stat arb trades.
Yeah, that makes sense.
I don't think we need to worry about what people call things, right?
Yeah. It's just an SAT question.
It's either a good trade or it's a bad trade. So it's doing that stuff, and then sort of DeFi Summer was kind of happening, and I'm a sort of unreliable narrator of this because I can't really remember. This was probably 2020, I guess.
Yeah,
No,
2019 was DeFi Summer, but certainly it continued on through the whole.
So a mate told me about this trade, which I won't talk about much because you guys know more about this than I did. But for a while, when all this kind of stuff was rampant, there were some very nice farming trades that you could do, where you could borrow money to supply liquidity to a pool, to an AMM, and then as you picked up directional exposure, hedge it out with perpetual futures. So you're effectively putting on, I don't know, sort of, let's say it's Radium or something. We've come doing this stuff at Radium and Orca and those kind of places, where you've provided Radium and USDC to a pool. You've now got some exposure to Radium, so you go and sell some Radium perpetual on FTX, and then this thing pays you trading fees and other emissions and stuff. You lose money into the pool because you're getting picked off by people doing arbitrage, which, as we'll talk about next, was also me doing that kind of stuff. And you're just dynamically hedging these pools. And it turned out that this was a really good trade for a while until it wasn't, right? Like, there was this kind of rampant time where this stuff unreasonably paid you tons of money, as people were, as the kind of environment was rampant back then. So Solana especially was a pretty good place to do it because there weren't many people, for structural reasons, doing the kind of MEV stuff that was diluting the payout on this stuff. So we were doing these trades, very super simple, right? They're just dirty carry trades where you ape into an AMM and hedge it. And the good thing about these trades is that they died really slowly, right? You're not really taking any directional risk, and you're just, or not much, and you're just betting that the fees you collect from farming, right, from the pool, is bigger than the amount that you're getting picked off in your pool and in your trading costs. And that, that's not going to just puke, right? That's like the basis trade, it just stops working, right? So this trade looked at kind of exactly like the short basis trade, where it's really nice, it's working, then it stopped working and we just stopped doing it.
But it's not just the basis, you also get those emissions, those tasty emissions.
yeah, the emissions, yeah. And this was great. There was stuff, especially like, was it Orca, and I forget the names of the places that were, but it was a crazy good trade for how dumb it was for a while. And then party's over. There's not an unlimited amount of money flying into things, right? So at the same time, so then I'm looking at these pools going, hey, look, well, there's trades here because these dexes were pretty mechanical.
Yeah.
And that led its way to, I guess, maybe I shouldn't be doing this on your stream, but that led its way to sort of slightly more predatory trades that we started doing online.
2 weeks ago, I said we need more suckers in this industry, so you're all good, dude.
So here's a sort of slightly more predator, and I would say that I wasn't being a predator. I was helping price discovery online. Well, we can say we were doing,
providing a valuable service to the market.
Yeah, providing a valuable service to the market. So here's a good type of trade. Is if you've got the same thing trading in lots of different places at the same time, then all things being equal, things that are the same should have the same price. But price discovery, if you've got, say, I don't know, Ray, let's just say Ray because we use it as an example, trading in like 20 different places, right? The whatever is sort of the marginal thing driving price discovery isn't happening in those 20 places at exactly the same time. Right?
Takes a while to permeate.
Yeah. So it's generally happening in sort of one place and then fanning out, or at least we can think about it doing that. Right? And it's usually happening in the most liquid asset or exchange, right? What you'll find is if you look at it is on average, moves on Binance will basically lag everywhere else, including on chain. Right? Big move on Binance, more often than not, the rest of the market's gonna follow that. Not always true, not true for every asset, but sort of generally that's true. Right? Yeah. So that led us to these really sort of simple dumb trades, right? Where imagine we're looking at some DEX, right? And it could be a liquidity pool on AMM, or it could be sort of an on-chain limit order book like Serum that we were also trading on. But either way, if we consider some instrument, right, there's a price that we can buy that instrument. Right? That's green line here. There's a price that we can sell that instrument, and because we're trading, immediately, the price we can buy it's going to be higher than the price we can sell it. And that's true if it's a limit order book. It's true if it's a AMM, right? Because our volume changes price. Now, so we've got those things. Now we look at Binance, right? And we say, hey, look, for that same instrument on Binance, that plus maybe some frig factor, right, is going to be our fair value for where we think the DEX should be trading. So we just look at the Binance price. We say, hey, look, the Binance price is there. Right? So now if we think Binance price is there, if we think we can buy it here, we think we can sell it here, then do we have a trade? And the answer, of course, is no, right? Because, if we're buying it, we're having to pay too much for it.
You have a very bad trade.
Yeah, we got a shitty trade. Yeah. Yeah. We take on fees and volatility if we take it. So there's no trade here, right? We have to buy it above its fair value. If we're buying it here, we're paying more for it than it's worth. We have to sell it for below its fair value. If we sell it here, we're selling it for less.
But you can take advantage of the people who are doing that.
Yeah. Well, so this trade, right, is we're waiting effectively for this to happen. Right? Imagine Binance jumps. Right? So the price on Binance is now up here, but because everything happens on a lag, and because, say, we're trading on Solana or something where it's, it's seconds before all these things kind of go through and get approved, then we have an opportunity if we're fast. Okay, so the fair value of this instrument's here, but the prices at which we can buy and sell it on the DEX have not changed. Right? They're still here. So if I'm fast, I can, because my good little kind of what are the words for those animals that live off other people's bodies?
Hyenas, right? Or vulture.
Something like that. So I can race, right? I can buy on the DEX here, right? That is a very good trade, right? If I can buy on the DEX here, parasite. Thank you. So the fair value of this thing is up here. I think, according to my model, right, fair value of it's up here. So if I can buy here, I've now just accrued an expected return this size, right? I've bought something worth this price down here. And that's a very good bet. And I can tell myself that I'm aiding price discovery on Solana by doing this, right? Because, these prices need to get up here somehow. Someone else is going to push them up there.
I mean, you quite literally are doing that. You're literally making price discovery faster across venues.
That's right. Yeah. So, stuff like this happens. What happens when you race? Like, you just race to take this liquidity that's sitting there and it's stale over here. So now something like this happens, right? Eventually the DEX price comes up, and the DEX price is now here, and the market's still wiggling around. Now, what I could do at this point is I could just hit the bid and get out of this. Sorry, hit the bid. I just mean sell, right?
So it's suboptimal on the other side too, to just sell it on the DEX.
Yeah. So I could go, look, I could just sell it, but I don't want to do that because it's worth this price, right? And I'd be selling it below what it is. So I just wait, right? It's wiggling around. I'm waiting, right? I already accrued this much expected return by buying too low. I just sit around, wait for it to wiggle around, eat the volatility. Then I wait for something like this to happen, right? Boom, back down. At that point, we've got something that's worth this price, which I can sell higher than it's worth. Right? I can sell it up here. So what do I do? It's exactly the same thing. I race just to take that liquidity and sell on the DEX here. And then once again, I've realized this expected return because I've sold something that is worth this price for a bit more. Okay?
Now, isn't there a way in this to buy at the green line before it reaches equilibrium, but actually get you can offload at the black line instead of the red line, can't you, using shorts?
You could try, you could try and offset at the black line by trading on Binance, right? So you could try and hedge out your exposure if you wanted by trading on Binance. But we found, because we were really early into this stuff, right? Like, we found that we could pretty much always just take good trades, right? Always take, on average, trades that are mispriced and just come in and out of positions. So we were just doing this over a large amount of things, large amounts of instruments and different places, just effectively waiting for this thing to happen, for the price to move, but the DEX to stay stale, and then opportunistically taking those good prices. And in the meantime, we've collected a bunch of positions that are wiggling around, but you're just waiting to be able to get out of them at good prices, because those wiggles ultimately are random, right? Those wiggles are ultimately volatility that will net off. Sometimes you'll get lucky, sometimes you won't. But we were early to this stuff, and it was, in a brand new sort of growing market. There's tons of opportunity to doing this stuff, and we were making money, every day, right? Every single day, this stuff was making money, making, not huge dollar amounts, but certainly huge percentage amounts, because there's only so much you can actually get get in this stuff, because
Yeah.
you're just waiting, right? You know, this liquidity isn't big, right? The amount that you can take isn't that big, so you gotta fan it out all over the place. Ultimately, this stuff's hard though, right? Because you've got to do a lot of implementation work to make it work, and eventually someone just comes along who's way better, right? And this is what happened to us. You know, if we were doing this stuff, we were doing it, say, on Serum and some other places on Solana, people noticed that, right? You know, and eventually someone with a better team who's, you know, far better at it comes along and they take your lunch, right? Because it's one of those trades where 100% of the P&L basically goes to whoever's best, right? You know, and it was a bit different on Solana because there was massive variance around the processing. So, you know, we were able to stay alive for a bit, but, you know, ultimately you can't stay competitive at this stuff for long, and you got to go and bounce and do something else. So that was on-chain DeFi Summer. Then we started doing dumber ape stuff. Like, dumber ape stuff. So, you know, everything that I've described so far was a really high risk or high reward to risk thing, right? It was delta neutral stuff. It was hedged. It was, you know, it was relatively, incredibly low volatility, right? Those were obvious trades that were obviously going to make money.
And
right?
you're in the equation of risk to reward, most of your focus was on minimizing risk and holding reward constant, right?
Yeah, well, yeah, my focus was mostly on doing trades that I knew were good. So I would have loved to have taken more volatility, right? I would have loved to have taken more risk, but I just didn't really know anything.
Okay.
So if I was doing this again, right, what I would do is I would have taken way more directional risk, right? Like I would have done those trades a lot sloppier. I would have taken a lot more directional risk, because with what I know now, I know I could have. I know that would have been a good bet.
Right.
But at the time, I didn't know it. I didn't know anything at the time, though. So I'm just doing the obvious thing. Right?
It also kind of explains that 20% premium on this future, because it's like,
yeah.
Why are people not taking this risk-free 20% ARB? Because they have a risky but still much larger, you know, amount to make by just taking that directional punt.
Yeah. Yeah. Right. Yeah. So then I started doing, I'm getting sort of braver here and doing dumber things, right? I'm doing more scalable things. I'm doing things that I suspect will last a bit longer. So we were doing sort of simple systematic trades, which would take advantage of things like trend, momentum, seasonality effects, and things like that. So an example was just around price extremes. Conditional returns tend to be higher. You know, around a new high is generally a good place to be long. Around a new low is generally a good place to short. So a toy example of this is this strategy here, which is in red, right? Is just being long any spot that's within 5 days of its 20-day highs. Right? And this benchmark, the green one here, is just being long all that stuff all the time. And you can see that, you know, just being long when it's making new highs has historically outperformed, right? And you still see trend and momentum effects pretty much everywhere you look when you're looking at crypto. Another sort of chimpanzee trade we did was day of the week seasonality, where, you know, there's reason to think, I think, that people do different types of stuff at different times. You know, people get paid at certain times. People are working some of the time. Various cultural things happen at different times. And we observed some seasonal pattern that we didn't really understand, where conditional returns of Bitcoin and Ethereum and crypto generally tended to be higher on Monday, Wednesday, and Friday. I think this maybe have changed a bit recently, but we just did a trade where we were just long Bitcoin and Ethereum every Monday, Wednesday, and Friday in UTC time, and then we just took it off for the rest of the week. And you can see that was a pretty good bet for a while. Never really understood why, but if you're not putting too much of your money in these things, you might as well have a punt, and you can manage them. You might as well have a punt on some of this stuff.
So yeah, I would love for you to check this out one time if you ever feel spry. But every time we stream, Bitcoin nukes. So like from 1 to 3 p.m. on Thursdays over the last say 4 or 5 months, it's tended to be among the most volatile time windows of Bitcoin on any day in any hour.
Well, hang on. I'm gonna write this down. What you say? 1 to 3 p.m. We'll have a look at it.
1 to 3 p.m. on Thursdays. Yeah.
Is that your time zone?
Yeah, Eastern Standard Time.
Cool. We'll have a look. So finally, like I'm coming to the end of my trial, and I go fast here, right? Because I've told you lots of things. Is we started doing structural things, right? Where at this point I'm understanding the market a bit better. Our trading on chain was mostly on Solana. Our trading on centralized exchanges was mostly on FTX and Binance. But I understood a bit, I think, around the SAM universe and Solana and Alameda especially. And there were a few structural things that came up on FTX, especially because of that. Now, regrettably, although I was smart enough to figure out these things, I regrettably wasn't smart enough to figure out that I probably shouldn't have money at FTX. So I sort of worked half of the way there, but just never really got to the end. But one good structural trade, which was very, very simple, was to just short all of the sort of SAM world perps that got listed into the ground. So occasionally, FTX would list something sensible, right? Occasionally they'd list a perp on something sensible, but often they would list a perp on this weird thing in the Solana universe, right? Or this weird thing that SAM was somehow connected with. And generally what they were doing, I think, was, just
giving themselves an exit door.
Whatever Alameda wanted to hedge and were axed on, right? Yeah. What that meant was that, outside of whatever happens on listing, whatever rampant weirdness happens on listing, generally from about 3 days out, right? This was going to be down only, right? These perps were going to be down only because there was this imbalance, right? There's a lot more supply from people trying to hedge stuff than there is on the long side. So simple trade. All these trades are conceptually simple. Just short whatever Sam listed as a perp, right? 3 days afterwards, and you can short it, rebalance it, hold the position, take it off after 100 days. Or that was what I did, right? I just eyeballed this and go, I'm going on average take it off about here, because there's no precision with an idea like this, right? You don't want to be messing around with profit targets or stop losses or trying to finesse how long to put it on. You just create some arbitrary systematic rules and do them for something like this. And the only thing you've got to be aware of with this is that the short grows as you lose money, right? You put on a short, if it flies up 300%, you've got 3 times as much of it. So you need to be disciplined in rebalancing it back, right? If you put on 10 grand, you've now got 30 grand of it, then you got to eat it, right, and cut back to 10 grand, right? Because who knows how that thing can spike. So good trade. Structural trade, good reason to think it exists. Very simple, just short the SAM perps into ground. This is not particularly actionable anymore, unfortunately.
Well, no, the thing is that the people who hang out in our Discord, like, they're looking at token unlock schedules, they're looking at team distributions, they're accumulating a knowledge of that they could use to derive where are people locked and want to hedge out their exposure to locked tokens, and then wait for that perp to get listed somewhere and express that sort of structural opinion,
Yeah, absolutely. If someone needs to do something, and if there's going to be rampant need to do something, that's going to be a great trade to get in front of, right?
Yeah.
Yeah.
That's like a type of trade that you can look for a lot in crypto because we have these
Yeah.
things like locked tokens and VC vesting distributions and things like that. You can spot it more often, probably.
Yeah, and those things do make a dent, right? You know, if you've got a bunch of people that are demanding liquidity, that is going to make a dent in prices, and that is a fantastic place to go and look for opportunities.
That rocks, dude.
Yeah. And a similar, good example of that, you know, someone needs to do something, someone needs to take liquidity. There were these leveraged tokens on FTX, which kind of acted a bit like leveraged ETFs. They were ERC20 tokens, I think, but effectively they held FTX perps within them, and they tried to be effectively a token that can only go to zero, so sort of bounded on the downside, that matches a certain leverage target of the daily move in Ethereum. So there's a sort of double one that tried to match, 2 times the daily move in Ethereum. There's a 3 times one. There were various things, but the thing that was, and these weren't particularly interesting because they, the expense fee that FTX took for them was absolutely criminal. For doing a really terrible job, because all they really needed to do was just, but if the market had gone up, they were buying perps each day at about 2 minutes after midnight UTC. If the market has gone down, they were selling perps about 2 minutes after midnight at UTC. And they were kind of doing this terribly, right? They were just smashing immediate or cancel orders, sort of marketable orders, into the market. And what tended to happen, if you knew that they were selling, assume that we knew that they were selling because the market's gone down, right? It's easy to figure out. We know they're going to be selling. What would tend to happen is that the moment it starts selling, we get this kind of shape appear, right? Where their mechanical rubbish selling causes the price to go down here and then just whoop, jump back up.
Yeah.
So our trade, right, was simple. Now, we didn't make much money from this, but it was a cool trade. You just kind of get in front of it, right? You know it's going to happen. You just sell ahead of their selling. You get in front of it, and then you cover as their sell order.
Or reverse.
Yeah, and you can play the reversal, if you want to, right? You know it's likely to happen. You can do the sort of reverse back in. In reality, we used to sort of stick buy orders down here where we thought it was going to come. Sometimes we trade the reversal because we got done a lot down here. Sometimes we wouldn't. But yeah, like here's the science. You can see this is my picture, but you can see it happen, right? This was the sell order here. Boof, this is it coming back. This is just the average returns around a sell event on FTX. And this is a great example of what Toast was talking about. If you know that there's some people that are demanding liquidity, right? They need to do something. They might not even want to do it, but they need to do it. In this case, it was a totally systematic trade, right? Just a computer that goes and does it because the fund needs to do it. Well, you can trade around that, right? If you think that's going to create a temporary dislocation like this, right? You can get in front of it and then you can trade around it. And you can again tell yourself you're a story that you're doing something useful here, right? These arrows are sort of squeezing the price impact, right? You're getting in front of it, you're smoothing out the price impact a little bit.
You had a great thread on that concept of like providing like much needed like liquidity of last resort as a service to the market.
Yeah, if someone's making a mess like this, right? Someone's got something to do, they made a mess. Like you can help smooth it out, right? If you're getting in front of it, you're pulling it earlier. You're then getting out of that position. Here, you're supporting it, right? It's not going down quite as far as it would have done otherwise. And I think it's reasonable to think you'd get paid sort of sustainably for doing stuff like that. It's the kind of market maker bank model, right? I think professional traders basically get paid for sort of absorbing the impact of this kind of stuff.
How did you find out about this?
Because I was looking at someone asked me about the leveraged tokens, right? And I looked at them and I was trying to work out how they worked. Because I was very confused about, there's one for Tether, right, which just sort of monotonically went up for some reason, way more than it should have done. So I was looking, and I never figured out why, right? I think FTX just made a mistake in a calculation somewhere. But anyway, that got me to thinking about the thing. I went through the process of being outraged at the expense fees on them. And then I looked at the rebalance. And I'm like, well, how are they rebalancing this? Because some of this stuff was pretty big, right? Some of this stuff, especially in, I think Ethereum was one of the bigger ones that we're looking at. Some of the trades that I calculated that they needed to do looked really big compared to the amount of trading that would happen within a few minutes normally. And then we started looking at it. And I remember the first time I looked at it, I'm just in front of the FTX screen looking at this thing. And you come down and you suddenly got, I think it was a cell, and you suddenly got this huge big dildo that appeared and then just reversed all the way back up.
Now, on the underlying, you're looking at it.
Yeah, no, I was looking at the perps, right? So the leverage token was traded. Trades the perps, yeah.
So the leverage token.
Hey, there's maybe a trade here. As it was, we struggled to sort of automate it broadly, and we didn't make much money at all out of it, but it was an interesting trade.
So Jim Talbot is a fan of you. I know that from his previous streams.
It was cool.
He's great. And I was watching a stream with him last year where he was like, I'd really love to learn more about what Robot James does and I'm not in that side of things, and it's very interesting to me. But at the time, he was doing this thing where he was just waiting for basically price insensitive buying while we were going down last year on Sundays at around a certain time period. And then just shorting it towards, when he started seeing signs of exhaustion and technical indicators, just shorting that. And it was like his only trade for weeks and weeks. And I thought maybe it was something similar to this, where it's like someone's rebalancing here or something like that.
Yeah. I mean, you don't. So this is an example where we understand what's causing it, right? But we don't need to understand it, right?
Yeah.
Often the stuff that I'm doing, the stuff I'm talking about is usually easy to understand because I want to educate people, right, and explain things. But often in trading, we don't really know, we just suspect, or we're looking for an opportunity that is a statistical one. We're going, hey, look, if this instrument has gone down more than it usually does versus things like it, that's probably indicative of some price insensitive selling or liquidity taking in this thing. And I don't need to understand why it happened. I don't need to be able to draw a pretty picture about it.
You just need to understand
on average, I can supply liquidity and sorry, I should stop using those words. On average, I can buy, right? And too much, I can buy. So that's a good example. And I think one danger with me doing these kind of talks is that I'm sort of selecting stuff that I can explain well here, whereas often trades are messier than that, right? Certainly they're usually messier than this, right? Usually we don't know exactly why a thing is happening.
Right. And so correct me if I'm wrong, but it seems like there's a lot more opportunities like that to spot, because you are selecting the instances where you knew what's happening, but probably a lot more of the opportunities that exist are ones you cannot explain, but that jump out when you start statistically modeling time series.
Yeah.
Like, for instance, like the trades that are based on a certain day or time of day or something like that.
Yeah. Or behaviors of similar stuff. I guess the standard thing that I would do if I was approaching a new market, if I knew there was a bunch of stuff that was similar, right? I don't know, a bunch of tokens that are similar to each other, is that I'd compare them and I'd go, hey, look, if one of these things relatively outperforms over some short horizon, right? The rest of them go up 1%, one of them goes up 5%, right? And that doesn't usually happen. Is that an opportunity for me to get short on average? Because what I'm doing there is going, hey, look, what I know about markets is that people occasionally demand to get something done, and that leaves a distortion, right? Which eventually will revert. Now, if I can predict when that will happen, like this, I can get in front of it, right? Here I got in front of it and then so on. But I don't need to predict where it can happen. I can just observe that it's happened, right? I can observe that everything else moved 1%, but one thing moved 3%. At that point, I've missed this trade, but I've still got this trade, right? I can still effectively donk it down. I can still observe the relative disconnect and I can donk it down. And those, I guess that's the traditional statistical arbitrage thing, right? And those trades are less good by themselves. But if you manage to do them really broadly, you manage to do them over lots of opportunities, those trades can be really good.
Yeah, especially if they're repetitive, because you might have missed it this time, but you might then start to pay more attention, at this time of month or time of week or time of day.
Yeah, and I don't even really need to understand them, right? I can just as long as it's working, as long as statistically those kind of bets are working out, you can just sort of observe them and whack them. And that was basically what I was doing when I started trading, right? I was doing sort of TradFi futures stuff like that, just to sort of a purely, hey, look, these two things are roughly the same thing. I'm going to observe disconnects and dump them back.
Okay. That friggin' rocks, man.
This was probably my favorite trade that I did of all of them. Which was that we talked about an inverse basis trade where you short the spot, long the future. I was short Celsius spot, and I was long Celsius perps, and I was getting
did that through borrowing and lending, right?
Yeah, borrow. So I borrow on FTX to short Celsius spot, and then I was hedged it out by long Celsius future, and I was getting absolutely reamed on borrow cost. Right, for ages the borrow cost was fine. I was collecting more funding than I was paying in borrow cost, which was the trade. And then all of a sudden it got absolutely massive. Like I was paying like thousands of percent per annum in borrow costs on FTX, and which was sort of working out kind of 250 grand was coming out in borrow costs or something of my account every day or something like that. So I was like, well, I need to squeeze out of this position. So I sort of squeezed out of this position and paid them. But it made me think, right? Like if I'm getting squeezed out of these shorts and the price is going exponential on me, then other people in that situation are likely to be as well, right? I am an idiot, but I'm not the only idiot, right? So then I started looking at this stuff, right? I go, hey, look, if the spot borrow cost got extreme, really extreme, right? Sort of thousands of percent, what does the price of the spot do? And I did a very simple simulation, right? This was just what would happen if I just betted my account on any coin that had a predicted lending rate of greater than 0.05% an hour, right? Which is thousands and thousands of percent a year. And you can see that it's pretty much squeezy up only, right? Like if you just ape into stuff when the borrow cost is really high, it goes up a lot. So doing
it's like longing stuff with negative funding.
Yeah, and it's like a really extreme version of that. Yeah.
Yeah.
So you're going, hey, look, I'm only doing it when it's absolutely ridiculous. And you can see that was a huge money maker, right? And I loved this trade because it was so stupid, right? Like we just look at the spot borrow cost. Whenever they got ridiculous, just start aping it, this ridiculous bit here, this was nearly all Celsius.
So that was an expression of what we talked about in the beginning of the talk, where I noticed that, when it gets this extreme, it doesn't stay there for very long.
Yeah,
right.
And that's a great place to look for when in an extreme environments, extreme things happen, but they don't last long, right?
Yeah.
So this is a great place to look for. And this, the trade was super simple. As soon as the borrow cost ticked down from not whatever our ridiculousness threshold was, we start coming out of it. Right? And like with all these trades, it's all fun and games on the way in when you're pushing the price up, and it's sort of slightly less getting out of it when your effectively supply is pushing it down. But this was a great trade for us.
Wow.
And probably my favorite thing. And I would look at I would look at this on other exchanges. Like I only really looked at this and did this on FTX, but there's it's probably worth looking at on other places, because like you say, squeeze dynamics are ubiquitous, right?
Yeah, that rocks.
And then finally, this is my last trade that I was talking about, and this was going back to what Toast you mentioned as well. We were doing these short basis trades where we were going, hey, look, this short position pays us funding, and then we're going to offset that directional position by buying stock. Okay? And then I was talking to a mate of mine, and he was like, yeah, I just don't bother with that spot bit. Right? I'm just sort of short the stuff that carries the most short, and I'm long the stuff that carries the most long. Right? And and I'm going, hey, look, I'm taking some directional risk, but they're probably mostly kind of net off and stuff. So we go, well, what if I did that? And I sort of simulated that here. So this is basically the same trade as the very first one I talked about, except that I haven't bothered to offset longs with shorts. I'm going to be long the stuff that pays carry if I'm long, and I'm going to be short the stuff that pays carry if I'm short. And I know that I'm going to take some directional risk doing that, because I can't possibly sort of completely balance it off, but that's okay, because I think it's a good trade for various structural reasons. And it was, this was an unreasonably effective trade, and I think there's a few reasons for that. One of it is that the stuff that got listed on FTX was, especially towards the end, was pretty much only stuff where there were ridiculous supply demand balances based on various people's holdings, and there was also a lot of
various people.
Yeah, we're trying to be. There's also like a lot of manipulation of funding rates, right? And I've written a thread about this, but if you were axed in one direction, it was pretty trivial to make the perp carry more or less in whatever way you wanted to do through small trades that manipulated the funding rate. And what you'd find, because people's inventory was pretty slow moving, that if they were manipulating the funding rate down today, they're more likely to be manipulating it down tomorrow. If they're axed in some position today, they're likely to be axed in that position tomorrow. So a very simple, naive, dirty carry trade where you're long the perps that pay the most long, the stupidest thing you can imagine, and then short the perps that paid the most short, was an incredibly effective trade.
That trade is still pretty effective, even when we're outside of the bounds of like this. The frequency of extremities was very high during that time. It's lower now, but even now, like, there is a certain range of extremity on the short or long funding side where it's like, I'm just going to take it because it's a no-brainer. Like, this is not going to be here for very long, which means by necessity, people will take the other side of this trade.
Yeah, and this this stuff was all in the extremes, right? If you're doing this trade, you're trading a lot of shit coins, right? Because
Yeah.
the stuff that's in the middle, right? The stuff that's paying a small amount of fund, that stuff isn't interesting very much because it's not affected by these kind of effects. So the issue with trading this, and this comes back to what I was talking about with execution of the basis trades, right? Your issue trading this is you're trading a lot of crap. You're going to be a large percent of the open interest in that crap, and you've got to be very, very careful with trading in and out of this stuff. So this trade, liquidity has its cost, right? This trade was the main reason that I had more money at FTX in the end than I wanted to. Because I think when FTX started looking dodgy, right? It was midnight or something like that. I was drunk, like it was a bit drunk. It was midnight. I wanted to go to sleep, and we were like, we need to trade out of these trades, right? But trading out of this position would have taken me all night, right? Because these are shit coins, right? I had to work out of this trade. We had like large amounts each side on this trade. And I taught myself into going to bed, right? I taught myself into, well, hey, I'll go to bed, I'll be fresh in the morning, then we'll trade out of it. And then I woke up and the Binance news had happened, and yeah. So if you're taking these things, you always got to know what's risky about them. And one of the things that's very risky about this stuff is liquidity, right? You end up with a whole bunch of horrible carry trades that are gonna take you a while to unwind.
Wow. Yeah. So this was towards the end of the last time that you were actively trading in crypto?
Yeah. So I basically stopped after FTX. So I was like, I'm tired. Right? I've had enough. Yeah. And then
you just got armed robbed by a vegan dickhead with pubic hair.
yeah. So I've had some times this year where I've played around with dexes and stuff, and I've kind of gamble around with my friends, right? Like one of my friends will say that they're trading something, and I'll click about with them because it's fun. But yeah, I'm not trading crypto seriously. I'm trading VIX futures mostly at the moment. And I'll probably get back into crypto at some point, I suspect, potentially. But I'm not in any rush.
Damn, what a wild ride! This presentation
it was fun. Like it was good going through this because I'd sort of forgotten. If you haven't done something for, I don't know, 10 months, something like that, maybe best part of a year, it sort of disappears from your head. So it was really good preparing this so I could remember and go through the research and go through what we'd actually done.
Wake you up for 2024, man. That's what we're doing here.
Yeah, get ready for 2024. So yeah, here's my main points I wanted to discuss, which was, if you approach a new market, like don't bet on stupid stuff, right? Like don't go, hey, look, even though I don't know anything, I'm suddenly going to start trying to know things and work out which projects are best and which things are going to go up and which things are going to go down. Like, because you just don't know, right? If you're new to a market, you don't know anything, right? You can't do any of the trade. So that's why you'll see at the start, the trades were simply, I'm comparing this number to that number. This number's bigger than that number, so I'm going to long the short little one, short the big one, right?
Yeah.
Those trades required no knowledge on my sort of side of any market dynamics. But you can see, like, by the end of that journey, I now understand the market a bit, and I'm putting on structural trades which require a bit of understanding of the dynamics of the market as well as taking directional risk. Okay, so I sort of got to that point where I was confident enough to be taking those trades towards the end, but I certainly wasn't there to start with. Like, to start with, I was taking like essentially the dumbest, most obvious, most sort of smash you in the face trades that I could possibly find, and they were all sort of involving just comparing numbers to each other, right? Like, this number's bigger than this number, that kind of stuff. So when you start trading, you just won't have any skills, you won't have any knowledge. So, you've got to take the obvious things first. Most important point, nothing more important than making money today, right? Don't fret that you don't know Python. Don't fret that you don't know how to do something. Don't worry about that stuff. Like, some
Thank
stuff,
God.
right? So take that stuff that and do your best with it today. And eventually you're just going to move forwards, and you're going to know more, and you're going to have more skills, you're going to have better tools, have better things. But don't get your head down and build stuff. Don't stop trading and go on a Python course. Don't, just do your best today with what you have, and you'll get there, right? You just keep doing that every day, and you get there. Then I thought I'd do, like, what would I be looking at, right? What would I be looking at if I was still trading crypto? I haven't traded crypto for like 8 months or something. What would I be looking at? Well, I think trend, momentum, seasonality trades are still a thing. I think the carry trades, like Toast said, where you just sort of, when funding's extreme, you're sort of long in the direction of it. I think those, it's a different environment, but I suspect those are still working, albeit more noisily than they were when I was trading them. The other thing I do is what we talked about, right? When we were talking about Jim, and we were talking about his trade that he'd noticed, right? And we said one of the things I would do is find a basket of similar stuff and just go, hey, look, if one of these similar things outperformed, does that subsequently revert? If one of those things underperforms, does that subsequently revert? And I think especially in less liquid instruments, those are still good trades. And you don't need to do anything fancy, right? Just get a bunch of returns, compare them, and just see if it's a big number, is it more likely to be a little number going forward, right? Does outperformance tend to revert? And the other thing is the thing that Toast mentioned, right? A thing I would be looking at is the stuff that you guys are already talking about on Discords, right? Distortions caused by large, predictable, structural stuff, unlocks, stuff like that, hedging demands, stuff like that, that's happening in DeFi. I think if you can stay on top of things, and staying on top of things is admittedly exhausting, especially for like a guy in their 40s like me. But if you can stay on top of things, those are great trades, right? Because you've got someone who needs to trade, you got these big supply demand imbalances. It's going to distort the market. It's going to make a bit of a mess. So that's what I've been looking at.
Yeah, help me walk through this just like as an exercise to kind of put what you're saying to practice, right? Like, let's take an example of a massive unlock, like say the OP unlock, right?
Yeah.
Like, correct me sort of where I'm going wrong here. I see, okay, a bunch of people who had locked tokens, institutional people, are now going to want to get out of some of that exposure. Presumably, some of them want to get out of the spot that they're in.
Mm-hmm.
Also, presumably, some of those people have already hedged out with perps.
Yeah.
So, sort of my second order effect presuppositions would be like, okay, I imagine that there's going to be far less demand on the short side for the perp or any futures. And I imagine there's going to be a far larger supply in the spot market.
Yeah.
Is that correct?
Yeah, I would think so. Yeah, you would, and like what I would do is just find a load of times when this had happened and then aggregate it, right? So look at what happens on average. That's a good observation. You have that observation. What do I think would happen? I think not everyone's hedged, right? But I think what you're describing would cause the basis to contract, right? Where the sell pressure in the perps is now lower, right? And there's extra buy pressure in the spot.
Oh, so I could like short the underlying and long the perp.
You could.
There's a dislocation.
Yeah, but I would imagine probably the best trade in that scenario is probably just to buy the spot. But I don't know, right? But I think the thing that I would do is it makes sense, right? You've got a thing that makes sense. I would look at what has happened on average around times like that. So the first thing I'd be looking at is the basis contracting or even shifting, right? through those things. We'd expect the perp to be trading at a big discount, probably going into that, which then would cut.
Would
So what I
close,
would
yeah.
do is just look to see if that actually happens. Because one really disappointing thing about markets is often we come up with these great sort of great ideas about what should happen, and then we have a look and it doesn't happen, right?
Or the opposite happens because
yeah.
everyone's already figured out that first order thing
Right.
that
Yeah.
yeah.
Right. Yeah. So the
Man.
the first thing is to just try and get clear on what you think is going to happen, and then try and find cases like it and aggregate them up. And then
Is
go,
that
"Hey,
something that you can do with eyeballs in a chart, or do you need data sets and then like
I
functions?
think it's really hard with eyeballs in a chart because I've had times when I've tried to do this kind of thing with eyeballs in the chart, and then subsequently analyzed it properly, right? And even on the sample that I was eyeballing,
My eyes have deceived
I
me.
saw the effect I wanted to see, and then when
Yeah.
I analyzed it properly, I didn't see that anymore. Right?
Okay.
I think
So-
it's hard. It's hard, very, very hard to be objective if you're just eyeballing stuff, even if you're trying really hard.
where does someone look, or what's
These
the
places are where you look, and what you're looking for is obvious stuff, right? I was never interested in opportunities that required some nuance, right? That I was never
Yeah, yeah.
interested in opportunities that require me to understand some 3D chess about the players involved with this unlock.
Yeah, like once you're at the level
Yeah.
of like, do they think that I think that they
Yeah.
think I'm lying? You're too far.
Yeah. What I would want to see, is unlock happens, basis reversal, right? Like, and
Right.
if I didn't see that, I'd probably get bored with that and go look at something else that was more chimpanzee. If you look at that sort of squeeze trade, undoubtedly there are sort of nuanced reasons why squeezes happen and why they don't. But I wasn't interested in that, right? All I wanted was a mechanical borrow got big, ape it. Right, borrow got big, ape it, and that's usually a good trade. It's not always a good trade, but I wasn't interested in nuance and 3D chess and understanding things. I just wanted some sort of mechanical thing that I can ape into.
It could also tend to make your execution as uncomplicated as it needs to be, as it can be, by like
right. You've got enough problems, right? Without one of them, you could, even when you've got a real simple trade, you've got enough problems in the operational side of it anyway, without making your life much harder. But yeah, I don't know enough about those dynamics to say anything useful. But like, I think what I'd be looking for is a real obvious evidence that what you've said is actually sort of playing out.
If one wanted to get started or get down the path, like the shortest path from I know nothing about going outside of eyeballs in a chart to like, I can use this and now I'm doing it. What's the quickest pathway there, do you think?
I think doing some sort of sensible but almost entirely systematic trading, and I think people who are good manual traders are doing this already, right? But some people are sort of sitting down in front of a screen and hoping for the best, right? They're going on vibes and hoping to notice things and stuff.
Vibes-based trading.
Yeah, that's right. So like number one thing is plan what you're doing ahead of being in front of the screen. Right? So let's take an example. What I would do, probably what I would suggest was that highs thing, right? What we know is that we know trend effects exist in spot crypto. We know that a coin that's making new 20-day highs or whatever has slightly higher expected returns than one that isn't. We know that a coin that's making new 20-day lows has slightly higher expected returns than one that isn't. So now you sit around and go, hey, look, what does my process for trading that look like? It's like, well, I'm going to sit down each day. I'm going to do some screen. I'm going to compare that screen to the positions that I currently have. I'm going to work out which ones I need to trade out of. I'm going to work out which ones I'm going to trade into. I'm going to have some systematic way to determine what my exposure is to each of those ones and how I rebalance. Then I'm going to go into the market and I'm going to put, I don't know, limit orders in the middle of the spread for all of those points. If I'm not getting filled within a certain point, I'm going to put a market order in and get filled. You know, the important, that's a sort of a trivial example, but the importance is sitting down and writing down all of the things that you are going to do and then doing it relatively mechanically when you come to the trading. And what you realize is there's a whole bunch of things that need to be thought about, and you know, pretty much everything is complicated.
Yeah, man, what a freaking masterclass, dude. I appreciate you so much for not only coming on but being so prepared and like sharing so much insight.
I wanted to do it properly. I hope it's been helpful,
dude. Best episode yet, in my opinion.
Thank you, mate. Thank you, man.
Yeah.
And hopefully, like 2024, I might even start looking at crypto, and I can.
Yeah, hopefully we got put the taste back in your mouth a little bit.
Yeah. Thank you so much.
Of course, man. We would love to have you back on when the market becomes way more inefficient in a matter of months or years.
Yeah, I mean, we need some good news, right?
Yeah. Yeah.
We need some good news.
Yeah, man. Would love to have you back on sometime soon. I know that all the guys who weren't able to be here today would love to learn from and talk to you. So we'll keep in touch, and thank you so much for coming on, man.
Thank you so much, my man.
All right. Well, the rest of y'all, if you want to shit talk with us, go to hxro.com, click community, and join the Discord. Quit being a loser. And to the rest of y'all, stay safe. Don't get wrecked.
Got me frozen and so better leave on. I swap it for time and I fake it for me. When we jittery base in 2 days, I'm on 3, I'm gone. Alamino Patron, Cappuccino Tuton, Alamino.